Hey everyone, today I want to talk about double calendar spread. And why do I want to do that? Because my trade number 224 was a double calendar earnings play on United Airlines. And for those of you who are new to my channel and you're wondering what I'm talking about, I document one of my option trades every single day for your benefit so you can learn from it. So let's get into it. I sold a January strangle $48 put option and the $55 call option, and I collected 77 cents for this. And at the same time, I purchased the strangle with the same strike, so the 48 put and the 55 call, but expiring in March. So this trade cost me $3.32. So it's a debit trade. And what I'm hoping for is that tomorrow I'll be able to close it for a higher value than that. So how exactly does that work? Well, let's take a look at this diagram that I drew. Hopefully it will make sense. Over here, the red line indicates my buy. So that's when I bought this double calendar. And because it's a debit trade, that's why I call it a buy trade. There are two blue lines in here which indicate the value of the strangles that I sold and I purchased. So this shorter line is the one that I sold. As we can see, I collected roughly about this much credit, and straight after earnings, we can expect the value of this strangle to diminish quite substantially. That's the reason why this blue line is dropping close to the zero line mark, and it does reach the zero line shortly after the earnings because this strangle expires on the 20th of January in a few days. So at the same time, I also purchased the strangle. So over here, we can see that the strangle that I purchased was a lot more expensive than the strangle that I sold. Therefore, I had to make up the difference. I had to pay for the difference, and that's the 332 debit or $3.32 when we're talking about options. Now, this other strangle, the strangle that I purchased, expires much later in time. Therefore, it will retain a lot more of its value after the earnings. So as we can see, the value is expected to drop, but not as much as the drop in the shorter expiration. And that's because the risk is still there. I mean, the longer you have your insurance policy, the more risk the insurance company is taking. So the same principle applies to options. So even though the earnings will come out, or in this case it has already come out, the options expiring in March will still have plenty of time, therefore it will retain its value. So what I'm banking on is that the difference over here is going to be less than the difference after the earnings. So that's how you do a double calendar play. I know it's a little bit complex. It is a relatively complex option strategy, but it's a very safe one because your max loss is actually quite limited. It's limited to the amount of debit that you spent on it. In fact, if this doesn't work out tomorrow, then I can always roll my position. I can always roll the strangle that I sold, and I can roll it to February, and then from February I can also roll it to March, so I can collect additional credits and I can reduce my cost basis. On the bottom chart, we can see how I expect the volatility to play out. So before the earnings, volatility tend to go up, and then straight after earnings, it just drops. It collapses completely, and it will remain at a low level for a period of time. So this was my trade number 224. And there was one other trade or two other trades that I did today. One of them was an interesting one. It was Robin Hood, and I had a leap call option. Leap call options expire far in the future. So in this instance, my option expired in 2025, 17th of January. And if we take a look at what happened with Hood, we go over to the daily chart, we can see that the price came down a fair bit from about the $10 mark, went below $8, and then now it bounced back and almost hit $10. So I opened this trade on the 22nd of December. So if we take a look in here on the chart, we can see that at that time the price was about $8, and I was quite confident that we're going to see a big bounce back after it was above $10 only a few days earlier. I did have to wait a few weeks, but now I was able to close it, and it was a fairly nice profitable trade. I purchased the $5 call option and I paid $4.50 for it, and today I was able to close it at $5.60, so that generated an annualized profit of 343%. So that worked out quite nicely. The other trade that I did was just my regular adjustment on my, I call them forever trades, which are on 3 of the index funds, the QQQ, the SPY, and the IWM. So today I rolled the put option up to 255 and I collected 36 cents extra credit for it. So currently I have the 255 and 300. So if we look at the daily chart, I am at a pretty safe distance from the current price with my strikes, and very soon I'll be able to roll my position to March. So I'm currently in February and I have a fairly nice healthy credit in it, $16.37, and that's because when I first opened my QQQ Strangle, it was back in April 2022, so 8 months ago, and my intention is to just keep it forever. So that concludes my trade number 224. Once again, it was a relatively complex strategy, a double calendar against UAL with the strikes of 48 and 55. And what I'm hoping for is that the price is going to remain between these two strikes. I hope you enjoyed this video. I hope you find it useful. And if you like that, please hit the like button, subscribe to my channel, and I'll see you on the next video. Thank you for watching.